Hello everyone, this is Ted Bauman here, editor of the Bauman Letter with your Friday Bauman Daily video. Last week I put out a video which ended up going viral on the topic of whether the market was headed for a double bottom. It's had nearly 50,000, I think over 50,000 views on YouTube so far and generated hundreds of comments. Now, there were quite a few people who really thought that I was onto something with the double bottom analysis. There were others who thought that I wasn't. I think the majority of people felt that it was uh, uh, quite likely that we were going to see another drop in stocks sometime during the course of the next couple of trading months, if you like. Whereas others said, look, don't fight the Fed. So today, what I thought I would do is actually talk about some of the responses that people made to that video and really answer them one by one. Now, the number one question that a lot of people asked is, why do you want to fight the Fed? The Fed has said it's going to pump liquidity into the markets. We know that that market is, or that those markets are going to take that liquidity and pour it into stocks, and that is going to push stocks up to high valuations, and so we're not going to see another drop. Well, my response to that really is that eventually the market will run into the problem of pure economic logic. Remember, stock prices are essentially investments in the future earnings of companies. And there's only so far that earnings can, or rather, that prices can go to exceed future earnings based on just the pure self interest of investors. Now, right now, I think a lot of people are piling into the market to buy stocks, partly for technical reasons. A lot of short sellers have been basically buying stocks at a discount to wrap up their positions and take their profits. We've also seen some opportunistic buying of people buying stocks at low valuations in order to lower their ultimate dollar cost, averaging their basis for their positions, which I'm going to talk about in a minute. But fundamentally, I think that in order for stocks to recover and to get back to anything like the significant upward trend that we saw previously, even to get back close to that, you're going to have to see the likelihood that earnings in the real world economy are going to improve. Now, I continue to maintain that that is not on the radar screens at this point, that there's no indication that despite what all the politicians would like us to see, that we're going to see this lockdown be lifted. We continue to see the emergence of new centers of infection around the country. That means that there are different parts of the country that are going to have to start lockdowns even if they hadn't had them previously. Now, if that's the case, there's really no reason to expect that we're going to see a rapid return to the level of economic activities that we saw prior to the outbreak of the virus. That means, ergo, that there's no reason to expect that the earnings of companies are likely to resume the levels that they experienced at that time, which means that if stocks are going to continue to rise, even on the basis of Fed stimulus input into the economy, it means that they're going to have to rise based on an uncertain, unknowable, someday return to earnings, which is not happening. We've seen dramatic collapses in earnings, for example, in the banking sector recently. Now, one reason for that, of course, is that the banks are doing the right thing by putting their free cash flow into reserves rather than distributing or describing it as earnings. They're putting it aside. So that's a case of diminished earnings as a result of a good move. But there are lots of parts of the economy that are not going to see an earnings rebound anytime soon. And I want to talk about that now by showing you a series of charts. Now, this first chart shows total retail sales, including bars and restaurants in the US economy. And I want to send out a hat tip to wolfstreet.com. It's a blog I read regularly. He assembled all of these from census information. So thank you for doing that. Now, you can see the drop here that we have experienced is steeper and almost as deep as the financial crisis of 2008. So we've seen a dramatic collapse in retail sales as a result of the lockdown. Now, if the lockdown continues as I predict, or if it migrates to different parts of the country, for example, Florida, places where the response to the virus was very late and very meager, then there's no reason to expect that we will see a recovery in sales simply because the decline in sales will simply migrate from one place to another. Here's another chart that shows the clothing and accessory stores. Now, look at that drop. That is just dramatic. It makes the financial crisis look like a walk in the park. Now, these are important businesses, folks. These are listed companies that are out there that sell clothing and the things, handbags, jewelry, all those sorts of things. All of these stores are closed. Look at that drop. These companies are going to experience a dramatic drop in earnings. And you can't cover that up by simply pumping liquidity into the market. People are not going to buy those stocks at these deep discounts, or rather with the earnings that these companies are losing. They're going to demand a huge discount. And I predict that as we see further information coming out on a monthly basis, it'll be worse. Now, here's department store sales. Also, a big drop. Now department stores have been on the way down for a while, but this could really be their death knell. We could see the end of companies like Macy's, others that traditionally we've come to expect to be in decline, but this really pushes them down to levels where these companies could wrap up. Again, huge pressure on that segment of the market. Look at furniture and home furnishing stores. I mean, that is incredible. The financial crisis saw a similarly sized drop, but it occurred over the space of 3 years. This all happened in a matter of weeks. Now, you could argue that we will resume and that this recovery will be very quick and that the government has pumped out money to cover this. But we've seen no evidence that the government actually can get these small business loans, for example, out quickly. In fact, today the headlines say that the Small Business Administration has run out of money for loans for these kinds of companies and, of course, smaller businesses. So I see no reason to expect a reversal of that. New and used vehicle and parts, also a deeper decline than the financial crisis, but at much faster pace. Bars and restaurants, of course, as everybody would expect, devastated by this. Now, these are not typically companies that are listed, but there are some restaurant chains in there that certainly are. Yum Brands, for example. All the fast food companies are experiencing significant declines in income. Sporting goods, hobbies, book, music stores, again, big declines. Now, here's one sector that is on its way up, and that's precisely why I've been bullish on companies like Kroger and Walmart and Target and others, because we have seen a big increase in their sales. So yes, that part of the market is going to help to lift the overall stock market. But what's interesting is that if you go beyond the most recent data, the March data, there's been a decline in sales in these companies in April, and that's because people have kind of got through their stocking up period. They're no longer squirreling away lots of food and other things. It's kind of business as usual, except of course now mainly on a delivery basis. So big spike there, but not necessarily good for their share prices. Companies like Kroger, for example, experienced an initial spike in share price, but has basically returned back to where it was before. Building materials and garden supply, I throw them in there partly to show that this is a category of companies that is continuing to do well. Companies like Home Depot and Lowe's, analysts consider that they are doing reasonably well. And I agree. And part of the reason for that is because that's one of the only places I've actually allowed myself to go during this crisis, is to go to local Home Depot or Lowe's, because most of what we're doing as a household is working on our garden. So yes, there are some bright lights in there, but for the most part, the picture is not good. So my prediction of a double bottom is based on the real economy. It's not based on the idea that we're going to see, speculative people coming into the market and buying stocks just because the Fed is pumping liquidity. Eventually, rational investors have to look at actual earnings, and the earnings reports that are coming out are not good. Yes, there are some companies based on the particular structure of their financial years that are reporting good earnings. We're seeing reasonably good earnings from some of the semiconductor sector, for example. But again, that's based on stuff that has happened already. A lot of that stuff happened prior to the problem. So I think, yes, there are two sides to every position. Some people may disagree that we're headed for a double bottom. But I predict that at some point, the accumulation of jobless data, which just hit 22 million folks, and all the other kinds of GDP figures that we have not seen yet are going to lead to another decline in stocks. as people realize how long it's going to take for earnings to catch up. Now, that leads to the second set of questions that people posed. A couple of people pointed out, well, you're silly to be talking about a double bottom because you should be using dollar cost averaging and buying on the way down to lower your overall cost base. Well, I didn't mention that specifically in the video, but absolutely that's true. I mean, there's no reason why you shouldn't be buying companies at the discount that they are relative to where they were before the crisis. The point of pointing out a double bottom is simply to say that there are likely to be steeper discounts coming in some of those companies going forward. So just because we've seen a rebound in 10 or 15 or even 20% in some companies' stock prices doesn't mean that you won't have an opportunity to buy them at lower prices going forward. My take would be to buy them on down days because we've seen down days and up days right throughout this whole period. The day I'm recording this, Thursday, happens to be an up day in some sectors and a down in another one. For example, yesterday, the only stocks that did well were those in the real estate investment trust sector, companies that pay dividends, they did well. Today, they're down as investors are shifting to other sectors that are more speculative. It's a back and forth like a yo-yo, but I still believe that we're going to see more opportunities for value buying. So obviously, use dollar cost averaging. Buy in little bits as the market declines, buy on down days, get your cost basis as low as possible, and then wait for the eventual recovery, which will come. We just don't know when it will come. Now, my last comment is for those of you who thought I was insane, frankly, to recommend the housing sector as a purchase at this point. The reason I did that is because housing is at such a valuation level. I mean, you've got big companies, big national housing manufacturing companies that are trading at PE levels of 3, 4, I think 5, things like that. I think the highest one of the biggies is around 8. Now, that is a massive discount. I mean, that's like 5 times lower than their PEs were even just in December. And we were only then coming out of an extended housing crisis. So my recommendation for buying housing stocks is not that they are going to recover immediately or that they are the big next thing. What I'm saying is if you're really looking at value stocks, housing is where it's at. You will not get steeper discounts than this. So don't get me wrong. When I recommend housing, it's not because I think that it's going to be one of the first sectors to bounce back. I agree that a lot of people are going to struggle to put together down payments. It's going to really slow the housing sector. But given the discount that these companies are trading at the moment, even returning to 50% of the volume that they had last year is going to result in a massive increase in these companies' share price. It's simple, folks. That's the way you buy value. Even companies that are facing a challenge. People, for example, are buying cruise lines right now. Why are they doing that? Under these circumstances, for the same logic, it's value. Now remember, investment is something that happens over time. I'm not saying you're going to recoup the money that you put into housing stocks over the next 3 months, but I guarantee you by this time next year, you will have made a lot of money if you invest in housing stocks. Again, even if they just recover to half of where they were at their current price valuations, their PE ratios, you cannot go wrong. So if that's insane, call me crazy. I think that's the way it should be. Anyway, this is Ted Bauman signing off. I'll be back next week. On Monday, of course, I'll have a video with Clint Lee, my research partner, where we talk about the state of the economy, so be sure to check in with that. Also, please do subscribe to my YouTube channel. A lot of you have. We have tripled our subscriber basis in the last week. I'm glad to have you here. Please comment. Please feel free to say what you like. Please note, though, that I can't really reply very effectively within the comment threads on my YouTube channel. It's managed by our business, basically by my editorial team. Where it's possible for me to come in and say something useful, I will. But generally, the best thing to do is what I've done today, is basically try to put out a video that addresses the thrust of your question and your response. I do appreciate those responses, even the ones that are nasty, who call me crazy and unarticulate. I respect you too, fellas. Anyway, I'll talk to you again next week. Ted Bauman, signing.